Good morning, everybody. I am Jay Marsden, Money in the Law, First Class Radio, WMRC, and My FM 101.3. My good friend John Drohan, Main Effort Financial, Jay Marsden, Marsden Law Group. Christian at the Con from Holliston Cable Access Television, helping to keep those 5 pounds off of us that the camera, I believe, I've been led to believe, puts on.
It keeps 5.
You know what the joke, of course, is, oh, the camera puts on 5 pounds. And somebody said to me, how many cameras you get on you?
It's 10 pounds. Don't quit your day job. Yep. Come on, not bad. Yep.
Good morning, everybody. We are here to talk about all things money, all things law. Get your Saturday going on. By the way, a little discussion about this coming in. Get your Saturday. For some of you, maybe you're taking the option of this as the holiday weekend. Some of you may be doing the push to the following weekend as the holiday weekend. Kind of get your choice this year, which is kind of nice.
Which is, right, it's fun. And so what I'm going to do is I'm going to do the obvious right answer, which is taking both weekends.
Always the genius. Welcome to
That's right.
It's America.
And sometimes it happens when the 4th falls on a Monday or a Tuesday.
Yeah. Last weekend wasn't a weekend, but I took it as a holiday weekend.
Well, and you ask yourself again, for those of you who haven't been listening regularly, our show usually starts out by Jay and I talking about our plans, like like what we do for fun and what we do, with respect to like vacation. So just indulge us a little bit on this.
Yeah.
So now we're going to talk. We are on the eve of 4th of July. Right?
Yes, we are on the eve of 4th of July. That's right. Which makes it July 3rd.
Which is it's not.
No, it's not. I think you're wrong.
But I mean, calendar. I'm saying it's coming. It's the next big holiday.
All right. So before we get into this, I want to just tell you one thing. So last weekend, we always talk about our plans. Last weekend, I spent the weekend with my daughter and a ton of her friends. They came down to the Cape for the weekend, and we hung around. We had a great time, beach day, all this other stuff. So all weekend long, in true teenage high school girl fashion, they kept joking around because I was giving them the business, telling them who's my favorite. And they kept saying, "Who's your favorite? Who's your favorite? Who's your favorite?"
Who's your favorite teenage high school?
Out of all those high school teenagers, out of all of my daughter's friends, who's your favorite? And I said to them, guys, you have all weekend to impress me. You have all weekend to impress me to let me know who your favorite is, and at the end of the weekend, I'll make a determination. Okay. So
how does this end well?
So at the end of this is where I'm going. So at the end of the weekend, they said, "Okay, Mr. Marsden, who's your favorite?" And I said, "Well, you know what, girls? You know what I'm going to do?" I said, "I'm going to announce it on the radio." I said, "So you all have to listen to Money in the Law."
This is
getting
even better.
Find out
is there some kind of
favorite
hold harmless disclaimer that I can sign that I was not here and I'm not part of this by saying, "Oh, you're my favorite."
Yep. So now, by the way, I'm going to put a caveat on it for purposes of last weekend. Now, this isn't forever. So if
this
you
is just one weekend.
If you ladies are listening, this is just for one weekend. So I don't want any hurt feelings. I don't want anybody to call me up and tell me, how I ruined your weekend or whatever. But I got to tell you, out of the entire weekend, not even that. Just conceptually, they're all my favorite. They're all my favorite. And you know why? Because it was just phenomenal to hang out with these guys and have a conversation and spend time with my daughter and spend time with their friends who are all super, super kids, and they all bring something special to the conversation. And when you talk to them, they're all just phenomenal, phenomenal kids, which means obviously by hook or by crook, they ended up with some halfway decent parents. And it was just a phenomenal
whose friends are these?
These are friends of ours from Holliston.
No, but I mean, which child? Which is it, Kendall or Riley?
No, it's Riley. This is Riley.
Okay.
All
so
Riley's
these are the high school
kids. All the high school kids. Yeah, all high school kids. Yep. So like I said, great weekend, a lot of laughs. The engagement, watching them, interact with each other and give each other the business for a couple of days, and there's one or two of them in particular that are really good at giving the business. They know who they are, and it was fun. It was a good time. So I loved having them down. So you're all my favorite guys. You're all my favorite, and don't give me the old. That's a cop out. It's not a cop out.
It is a cop out, but from a legal standpoint, it is exactly the right answer.
That's right. That's right. Well, very diplomatic. Well played.
Your diplomacy knows truly no bounds.
No bounds. Yeah. No bounds. That's right.
I will say this, that that's for so middle school just finished up, and my oldest has already been through high school, so. Every time I was able to kind of be part of a function and be part of, like, whether it be a sports team or whether it be like chaperoning something, you know, where people would be like, you know, I would always get like parents would go, "Thank you, you're giving your time." I'm like, no, I'm doing this strictly for me. Like it's
purely selfish reasons.
Yeah, because you get to see it, you get to kind of go and watch it from, you know, you're still at standoff distance, but you get to see, you know, high school in action. Where, you know, for us, you know, high school is 1,000 years ago.
Oh yeah,
and
it's changed so much.
Right, and high school's different. I mean, high school was. And summer in high school, I mean, think about it. Like I can, you know, there's something, you know, I can't remember what I did 4 days ago, or I can't remember what I did 4 weeks ago, but I can remember, I have, you know, distinct memories of, you know, my freshman to sophomore year high school summer, and things that happened during that, and my sophomore to junior year high school summer, right? Because back then summer lasted so much longer, right?
Yeah.
Summer was like this
seemed like
huge,
it did.
yeah. Like, not now. Now it's like 6 weeks before. Oh, and
well, I guess when you have 12 to 14 hours a day to do absolutely nothing, it goes a little slower.
You ain't kidding.
Yeah, yeah. So, by the way, end of the weekend, I was exhausted. One of the things I was not prepared for was the 3-day dance party. Okay,
oh, yeah.
So I heard I heard my fair share of High School Musical and anything that sounds like High School Musical, because they all sound like High School Musical. So.
You can't really go wrong with that.
The 7-girl hour-and-a-half-long accompaniment going down to the Cape. Nothing, not something to be missed, but glad I did it. Not sure I need to do it again. So
that's doing it next week.
That's right. That's exactly right.
So all right. So thank you again for indulging us and letting us talk about like some of the things that we do that have nothing to do with neither money nor the law. But you know,
we get to talk about our favorite thing ourselves, so it's fine. It's fine.
Right. So with that, let's caveat, or let's kind of launch into what we're going to talk about, which is just as interesting as ourselves, which is, are we agreed that we're going to talk about this?
We did agree we're going to talk about this.
Okay,
yes.
so
at least you said we're going to talk about this. Smooth transition, by the way.
Well, I also gave you a hand. I gave you a read ahead, which I'm sure you took care of.
You know I did.
Did anybody do the reading?
No.
So we're going to talk about the tax changes for 2018. It is the eve.
Still my heart.
It is the eve of July 4th, and you're saying, why on God's green earth would you want to talk about the new tax law and the new tax code? And here's why: because it's on the eve of July 4th, and you know what? You know what? It's not on the eve of April 15th. Or on the eve of December 31st.
Oh, absolutely right.
So we're talking about this now, knowing full well that you are not going to do a damn thing about this this weekend or next weekend.
Wait a minute. This isn't going to be a topic of conversation on the beach July 4th?
No. We know. Believe it or not, Jay and I, although we look very young, and we play very young, right? They think, wow, these guys, they just get out of like
high school, college.
People look at Jay and they say, weren't you in the paper chase? Like you're that guy, like right coming out of law school.
Yeah, absolutely.
You know, he still, you probably still have tattoos of like patches on your elbows.
Yeah, absolutely. Yeah, I still carry I still have the tassel from my high school graduation is still hanging from the rearview mirror. Yeah, that's right.
So believe it or not, we've actually done this for a little while. Actually, more than a little while. So I'm telling you right now, and you know this as well as I, all we're doing is planting the tax seeds. Planting the seeds of like, look, you need to start thinking about this before it's too late to start thinking about. You need to start at least have an understanding of what's going to happen and how it's going to affect you before it's too late, before you're just reacting to it, before it's December 31st is come and gone, or April 15th is come and gone. And, I can't adjust my tax. I can't lower my taxable income. I can't, I didn't realize that I wasn't going to be able to deduct this year as opposed to last year. So we're just going to give you a little, like a little taste, like a little
kind
teaser.
Of whet your appetite.
Yep, of what's going on with the tax and the things that affect most of our listeners.
I like to refer to this as a tax appetizer.
Oh yeah.
Yeah.
Could we? I mean,
I'm not even going to say taxitizer.
You were going to say tappetizer. Yeah, a tax. I like the tax.
Taxitizer.
I like the taxitizer.
Excellent.
Yep.
All right.
So what's on the menu?
Hashtag.
What do you have for taxitizers? Well, I have this right here.
Yes. Excellent. Yes. Well, do tell. What's on the menu?
Okay. So there's plenty of things on the menu. There's just to give a little bit of review. The Republican Party pushed through a tax reform this year at the beginning of close to the beginning of the year. At the end of 2017 for the tax reform for some changes in the tax code for 2018. And for all of you people who are very close with your accountants, I'm sure that your accountants have briefed you on this and gone over this in grave detail.
God, yeah.
Yeah, I'm sure they have. But if they haven't, Jay and I are here to help. So there's some changes that have come up that, you know, although they're somewhat subtle, in many cases, it may affect you, it may not, but in many cases, it could affect you just enough to where you're like, oh, that's interesting. You may approach your whole tax planning a little bit different based on some of the things we're going to tell you. So, first and foremost, I want to get into some of the really, really fun parts of this.
Jumping into the meat and potatoes
right away. Well, the biggest meat and potato thing is the overall taxes have gone down. So
we'll see.
Well, in theory, as I look at this, so what was the highest tax bracket? Okay, it's not 40, but just under that. Highest tax bracket used to be
just south of 40.
Used to be just south of 40 or 39 point. I don't know,
maybe
5 or
close,
6.
right in the ballpark.
Okay, yep. So the highest tax. So for those people who are doing well, who are making really good money, the highest tax bracket used to be 39.5%. So that means essentially 40 cents on every dollar you were paying that you made, you were paying taxes on. Right?
Okay.
Guess what? That's gone down.
Oh my gosh.
That has gone down. And now, the highest tax bracket is 37%.
Wow, that makes sense. Now I know why. My back was bothering me because my wallet now is so much more gigantic.
It's so much because the money is going into more into your pocket.
Right. That's why I'm saying my back's bothering me. Now I know I gotta carry more cash.
So why is that significant? So when the significance of this is that the whole tax bracket, all of the tax brackets have changed, and because they've changed, you could find yourself in a situation, again, depending upon what your income is, you could find yourself in a situation where you may be required to pay less tax. Now, that's the top of this. That's the top of this refrigerator. We have to clear all the way from the top to the bottom. So the first thing is that the taxes have been adjusted down. However, there have been some things that could contradict that. Could take this to not necessarily that you're going to end up paying less taxes, because on the one hand, if I pay less taxes, but also the deductions have changed as well.
Sure.
So let's talk about some of the deductions that are changing. So first and foremost, there's a deduction. What's one of the biggest deductions that you have on your taxes?
Property taxes, mortgage interest.
Your property taxes, right? So your state and essentially it's your state and local taxes, which is for many people, for homeowners, it's your property tax. So now there is a little bit of a change. And the change is that you are only able to deduct up to $10,000 of property tax. What? Now, translate that for me, right? I mean, I'll translate it, but if you want to translate it for me, you can.
Please do. Yeah, lawyers always make things sound much simpler.
Well, you make things sound smarter because you
point.
are, So what that translates to is that, let's say that your property taxes for your house, so you pay your real estate tax, and let's say your real estate tax last year was $9,000. You paid, which is not an insignificant.
In Massachusetts, in the Northeast, not unusual.
That's real tax. So let's say you paid $9,000. Guess what? No big deal. You get to deduct all $9,000 of that. Let's say, however, that you live in a house, I don't know, like this, or let's say, even better, let's say that you have property, let's say you live in a house that's, I don't know, bigger and nicer, or you live in a place that has higher taxes, and let's say your property taxes was, I don't know, $15,000 or $16,000.
Okay.
And you're like, well, I live in that's a lot of taxes. However, in years past, you'd be like, hey, well, at least I get to deduct the property tax. I mean, I pay a lot in taxes, and don't get me wrong, I don't like letting taxes wag the dog, but at least I get to deduct that.
Well, and don't laugh. And a lot of people made that calculation. A lot of people bought into their property and said, okay, let's do the mortgage calculation. And the mortgage folks do the same thing. They walk you through the whole transaction, and they say, okay, your mortgage is going to be X amount of dollars. Your property taxes added on top of that. Here's the number you're going to pay every month. But don't forget, you're going to get a deduction on your property taxes. So your real out-of-pocket cost is going to be X, less than that. So people made substantial buying decisions around that concept.
Sure. Now, granted, like I said, we don't ever want to encourage people to let taxes wag your dog and make and have that be the driving force. But it helps, right?
Yeah.
It helps
Yeah.
when you're looking down the business end of a $15,000 or $16,000 tax bill, which is going to go up. Like, that's the thing.
They don't go down. No.
Taxes rarely go down, and that you can and there's
well, the property tax side, they don't, because it's the only thing to fund your local municipal government.
That's right. So they're never going to go down, and you're like, okay, I'm buying this house right now. I'm looking at $16,000 a year, which is just going to go up. Well, like Jay said, you know what? Maybe we can make this work, or maybe it'll take a little bit of the edge off because I'll be able to deduct it. That is changing. So now remember, we said taxes are lowered, right? They're like, hey, we're lowering taxes. Did you just see that? It was like almost like a magical thing. I mean, I know you didn't see it on the radio. Yeah, it was great radio. Yeah. What was that? You have taxes going down, but now one of my significant deductions of real estate tax is going to be limited, and there's going to be a ceiling on it of $10,000. So everybody let that soak in, all right? And if that's an issue, or if that's something that you need help with, by all means, contact us. We're more than, but contact your
And by the way, this was a big deal at the end of last year because there were a lot of people running around with their checkbooks trying to get property taxes prepaid to a certain extent, to try to kind of, beat the man to the bank on this one and try to make sure they can get that taken care of. So now, the assumption is that you're in the 18, right? That's it. Your number is your number. It's not, you're not going to have that opportunity to kind of move the deck chairs around a little bit.
There's no, moving the deck chairs around on the Titanic. Although sometimes it's not the Titanic. This is like the Queen Victoria. This is the Royal Caribbean.
All right, it's Carnival.
It's gonna be. It's just maybe a Carnival.
It's a spring break cruise.
It's a
Settle down. Settle down.
It's one of those. It's a really bumpy boat.
You're not reading a book.
So that's one significant deduction that has some limitations on it. All right, let's go into one more. All right, so this is one more, and I actually. Now, you know what? I'm going to save that one for after the break. So let's take a break right now because I need some legal advice for this one.
Oh, okay.
And I know that I pretty
much
that
a sidebar.
Every time I come and do this show, I bring in some legal advice, which is actually the host of the show.
Sidebar.
We'll be right back on Money and Law on MyFM 101.3 in the New England Bonsai Garden Studio, and also affiliated strongly with the Holliston Cable Access TV, so you can actually see us. And for those of you listening on the radio, MyFM 101.3, arguably the greatest radio station in the history of radio.
No argument about it, my friend.
We'll be right back.
And you're back, Money and Law, MyFM 101.3 here in the New England Bonsai Garden Studio. He is John Drohan of Made Effort Financial. I'm Jay Marsden of the Marsden Law Group. And Christian has joined us here. I think Christian, this next question is, Christian brought this up. I don't know if this is something he's got going on personally.
Oh, no, wait, hold on.
All right.
Before we get into that, there's one more deduction I want to talk about before we get into the big one, because Christian asked about this, and we found it a little puzzling that someone...
It's his own business. It's his own business.
Yeah, we're not going to get personal about why Christian might be paying alimony right now, but you know what?
Separate issue.
We'll get to that. Another significant deduction. So we talked about the limitation on real estate, on a deduction of property tax of $10,000. Here's the other one. So for most people, most homeowners, what's your second biggest, usually your second biggest deduction that you have?
Oh, it's your mortgage deduction.
It's your interest on your mortgage, right? So in forever, we've been able to deduct the interest paid on our mortgage, not only on our first house, but also on our
second property.
There you go, right?
No questions asked.
So properties 1 and 2. Great deduction, and which, again, you talked about how this allowed people to be able to put themselves in these positions because they're like, hey, look, you know what? I can take out this mortgage, and when we budget things out and kind of at the end of the year, we're going to be able to get some money back because we're paying a lot of, our mortgage is higher. We needed a bigger house. We can afford it, and part of the reason why we can afford it is at the end of the year we're going to be able to deduct all this interest.
Well, you tell me if this is something that ever happened to you, but you'd have clients that would say to you, I'm almost getting ready to write my mortgage off, and now I'm losing the deduction, and then they'd start doing some calculations to say, maybe I want to carry a small mortgage or some mortgage on this property to some degree because without it, I have no deductions. Yeah, and they sort of looked at that, and advice around it's a different story. But you would see it happen. People would talk about it and say they saw it as a benefit.
I agree with you. I agree with you to a point. And again, I'll always come back to this throughout today's conversation. I don't let taxes dictate what I'm going to do.
I agree. Understand.
I mean, people talk about, I don't want to pay tax. I want to pay less tax. I'm paying taxes. Everybody pays taxes.
Oh yeah.
You have to pay taxes. Taxes is part of the deal. Like there's no getting around it. You don't want to pay any more tax than you have to pay.
That's right.
That is by the law or your individual situation. But you're paying taxes. So the idea of like people say, well, I want to carry a mortgage, in order to have my deduction. I'm like, well, you're also carrying. If you're carrying a mortgage, you're paying for
yeah,
it.
It's debt. Yeah,
you're
it's
paying
debt.
for. You're paying. You pay to borrow money. You pay to hold that debt. Now, I agree with you in the sense that when someone says, "Well, I'm going to pay up," or I need to pay off my house right now," and I'm like, "Hey, whoa. Don't be in such a hurry to like unload that $50,000 that you have in the bank, because this is how much it's going to cost you to be able to keep that money."
Yeah, it's working for you.
That's
so
right.
It might be working harder than you think.
And so if you're paying, if you have a 3% mortgage, or if you have a 3% loan, whatever your debt is, and you have $50,000 in the bank, and that's all your money, right? That's your emergency fund. That's your anything I need to do. That's my money. If I then pay off my debt, right? So let's say if I'm paying off my mortgage, then yeah, so that's great. I paid off my mortgage, so I've decreased my overall cost, but now I've lost all my liquidity. So being able to deduct that, right? Being able to deduct the interest that you pay on that takes some more of the edge off of that. So that. So Jay's absolutely right in that. Yeah, sometimes carrying debt isn't as bad as you think, and part of the reason is because I get to deduct the mortgage.
Well, and you're redeploying other assets.
Exactly.
Other assets that you're working for.
And you're keeping flexible, right? And that's what we always want to stay flexible. Like me and you. We
flexible.
are flexible. Like,
absolutely.
Look at that.
Yep.
Look at that.
Don't hurt yourself.
Speaking of flexible, softball season's over.
I heard all about it. Yeah, I read all about it. What a write-up. What a legendary finish.
It was a legendary finish. We played against your brother-in-law.
Oh, yeah?
Yeah, Mr. Higgins. Great, probably a first ballot Hall of Famer.
Oh, great ball player. Yeah, great ball player.
First ballot Hall of Famer in the Old Man League. Anyway, okay, back to so the second deduction is mortgage interest, and there's a change in that. Are you ready?
Of course there is.
Okay, so the change is, and for many people this isn't going to be that big a change, but for some people it could be. So you are allowed to deduct. They're putting a limit of how much interest you of the amount of loan that you can deduct interest from. And that loan is $750,000. Now let's just take all that in for a second. So if you have a loan north of $750,000, then one of two things are going on. One is you have
You're
money.
Killing it. You're
you
killing
have a lot.
it.
You have
You're
a lot of money
it.
because that thing ain't cheap.
Oh no.
Nope. The monthly payment. The
God
monthly
bless you.
On
go get them, Tiger.
Loans of
yes.
$750,000.
Mom and Dad are proud. Mom and Dad are proud.
That's real money, right? So you're doing. You're in a very strong financial position with a very strong cash flow.
Yeah.
Or two, you're leveraged beyond hilt and you are in trouble.
Yeah, the words of Ben Stiller. How's your portfolio? It's strong. Strong. Yeah.
So the $750,000 for many people, they're not going to be there. Right. They're not going to be. That's not going to affect them. Meaning that their loan, and again, this is the combination of both your first and if you own two properties, your first and second property. So if I owe $300,000 on one property, $450,000 on a second property, I can deduct all of the interest that I pay for those loans for the year. Then I'm good to go. Anything north of $750,000, I can't deduct that interest. Now that doesn't mean I can't deduct the $750,000 up to $750,000.
That was the question, right? So you can deduct up to the $750,000.
Yeah.
So let's say if the $750,000, if that mortgage interest is $20,000.
Yeah.
And then you add another $5,000 on top of it for the last 50 between $750,000 and $800,000, you can deduct the $20,000.
Yep.
But they cap your deduction at whatever the total of the $750,000.
I can still deduct my mortgage interest, but I'm going to be capped out there. You're exactly right.
So can I ask a mechanical question?
Mechanical.
So you have an $875,000 mortgage, right? So so what do? Do they take your $875,000 and then they say, well, John, your rate is 3% on the $875,000.
Yep.
So do they apply a 3% to the $750,000 for you, and they say that's your number?
Yep. It's based on right. They don't change the interest rate on
right. So it's your interest rate.
Yeah.
On whatever loan you owe,
well,
they just apply that to $750,000, and for you as an individual, that's your cap.
The proration. So it's all based on the number of what you paid in interest. So so I have my principal and my interest. This is how much I paid in principal. This is how much I paid in interest. This is how much the loan was for. This is how much the loan's for. So then that calculation is based on the amount of interest that I paid. So it'll be if my loan is 10% more than my $750,000, then they're going to do it. Then they'll 10% of my interest I won't get to deduct 10% of the interest that I paid.
So if my rate's 5% and your rate's 3%,
yep,
on the $750,000,
you're getting your 5%.
And you're getting 3.
Yeah, it's
Okay.
whatever I paid. It's whatever I paid.
I understand. Yeah. But
you can't change your interest rate. You can't.
No, I understand that. But what I'm saying is you're now creating truly an individual tax calculation for this particular thing that's dependent on something. Before it was just whatever your interest is, and that's fine. And everybody knew I just get my interest.
Yep.
Now it's, well, I get my interest, but it's my interest on $750, and then my number is based off of whatever Wells Fargo, for example, is charging me.
That's right.
That's how they calculate the number.
That's right. And your accountant will help you with this.
Well, he's going to say, yeah, I need to know what your mortgage interest is. And,
Yeah.
All right. Okay.
Your accountant's going to say, give me all your stuff, and most people will then give them like a shopping bag full of paperwork.
It's a strangely personal calculation. I'm just saying that's what I find.
It is a strangely personal calculation, but it's something that you want to do because it's
worth it. Oh, it's worth it. I'm just saying I just find it.
But here's the problem. The problem is, again, I come back to my original statement. If you have more than $750,000 of mortgage,
I'm saying congratulations. You're very successful, and the number for Solaris Hill Advisors and Manafort Financial is, take your pick. Either one.
They're both good.
Both the same.
They both
yep.
handle
big
numbers.
That's right. And they both, they work together.
Okay. So those are our two. Those are the two changes, and those are the ones that are going to get the most. They're going to get the most flash and bang. They're going to get the most press. They're the things that your accountant's going to be talking about most. Is your ability to is what your deductions are. All right. So back one more deduction before we get to Christian's problem. Or not a problem.
Maybe not a problem.
We'll figure it out. Maybe it could become a problem.
If we're solving it, it's not a problem.
That's right. So and so one of the other things is that when people itemize their we was talking about itemizing your deductions and you get to, all right, well, if I go through and I give all my stuff and then my accountant's going to figure things out. Your accountant may be the smartest person on earth, and we know some pretty smart accountants.
We know a pretty smart accountant. We might see him tonight, as a matter of fact. I might.
Yeah, he's not going to like that. But so your accountant may say, look, I can figure a bazillion different. I can skin this cat any way you want. But at the end of the day, there's going to be a number of how much money you can deduct from your taxes. How much you can have, whether how much your deductions are all going to add up to, and if your deduction is less than what is known as the standard deduction, then it doesn't matter. Then you just wasted a bunch of time because, well, you didn't waste time, but you realize that, look, if my deduction is going to be $20,000 and the standard deduction is going to be higher than that, then I'll just take the standard
all
deduction.
day long.
Oh, yeah.
All day long, twice on Sunday.
This, and Jay just pointed this out, this is the third and probably another one of the most significant changes of the tax code for 2018 is that the standard deduction nearly doubles. So what that means is that
sit down.
For many people who have been, killing themselves to itemize their, and say, oh, I deduct this, I bought this pencil.
They save every scrap of paper, every gas receipt,
right.
yeah.
They may find themselves where the standard deduction is better than what they were doing before. So
it's liberating.
So here's your standard deduction changes. So the standard deduction nearly doubles. So if you're a single taxpayer, your standard deduction is now $12,000. So that means no matter what, if you take the standard deduction, you're going to deduct $12,000 off your taxable.
Just for taking the wrapper off the 1040 and getting ready to fill it, they give you $12,000.
$12,000. All right, and then for married filing jointly, it's $24,000. $24,000 and $18,000 for a head of household.
Amazing how that 24 works. If they take that single, they just double it.
Because there's two of you, and in our country, you're only allowed to be married to one person.
Right, that's right.
So that's
depending
why
on where you are, it's different. But
that's why right. the double. I mean, if you were allowed to marry,
first of all,
that would throw them.
First of all,
it ain't worth it.
First of all, who would do two at the same time? Right? Who would get married twice at the same time? It's crazy. It's crazy. That's a separate show. That's a separate show.
That's a separate show that we don't really have.
That's right. We don't have time for that.
Yeah.
Maybe we'll talk to Christian about that. But what do they take away? How do they get you there?
So. Wait, what's your question?
Yeah, well, what do they took something away to get you to the standard deduction but to double the standard deduction, they took back your personal exemption.
That's right. They've rescinded
before you got both. Before you took a standard deduction and they gave you a personal exemption.
Yeah,
they've eliminated that.
Now it's one or the other.
Right.
Well, it's not one or the other.
No,
it's just the personal exemption has been taken away. So now you just get the standard deduction. So again, all this stuff kind of when you know kind of this was unveiled and the curtain opened up and everybody said, oh, look at this great new tax program, this new tax bill.
I'm not sure everybody said that, but whatever.
Well, some people did. I mean, there were some people that were like, hey, look at what we did.
Yeah.
It's not all. It's not as not as black and white that it's going to be better for everybody.
Or as we like to say in the legal profession, what the big words giveth, the little words taketh away.
That's so true.
Yes,
that's so true. All right. So without further, all right. So those are the three big things. Your standard deduction has increased. Your mortgage, your real estate tax, your real estate deduction has capped at $10,000, and your mortgage, the top mortgage that you can deduct interest from is $750,000, and that's important. Okay. Now,
let's get to the big one.
All right. So listen, Christian.
Again, don't press him on why he asked. He just asked the question. So answer it.
So Christian, right now, you've been paying alimony. I think he's paying alimony to two people, right?
That's two that we know.
Two women, right? So Christian is paying alimony, and I have bad news. No longer will you be able to deduct your alimony payments.
He's heartbroken.
He's heartbroken.
Right, all right. That sound you hear in the back, that's him sobbing.
Slamming his head
weeping
against the wall.
Weeping openly.
Yeah. So Christian, again, not sure why you got, you know what he is? He's probably like one of those, I mean, he's in the film business, right?
That's right.
So he's probably gets kind of caught up, he spent some time in LA. Next thing you know, he's married, he's in Vegas, he's married again. He's, so. And
that's one of those, you see those all the time where they get, then the next day there's like they're almost like happening at the same time.
Right.
Serial
wedding
guy.
Yeah.
Serial groom. He's a serial groom, we call that. Yeah.
Well, you know what it is because he's irresistible, right?
Yep.
And
delightful.
He can't
delightful,
help it, right?
Yep. Delightfully personable.
The parents love him right away.
Of course.
So we're embarrassing. Christian, I don't think, is paying any alimony, nor will he probably ever pay any alimony. No.
All
right, so
you or I? That's a different story.
So before this year, the tax code for people who are paying alimony, it went like this. So if I'm paying alimony, then I get to deduct that from my. I would deduct that. So if I paid, $50,000 in alimony in a year, I would get to deduct that, and then the person who was receiving the alimony would have to claim that as income, right? So now, guess what? No more. Now, I don't get to deduct that. And I'm sorry, no, the person that was. Yeah, that's right. So I don't get to deduct that alimony anymore.
As the payor starting in 2019.
Yep,
that's correct.
As the payor starting in 2009. So for 2000 beginning in 2019 as part of this plan, I no longer get to deduct the alimony payment.
Okay. But what about the person getting the alimony?
So the person that gets the alimony, then now they're the ones who have to claim it, right? So they're the ones who then. So if I say here it says phase out. Yep, the person who receives the alimony, they're the ones who now have to pay the tax on that.
So alimony will not be taxable for divorce decrees signed in 2019 or after. That's what you're telling me. So if you get divorced in 2019, your alimony is not taxable. So the person getting it is not taxed on it.
That's right.
And I don't get a deduction on it.
And you don't get to deduct on it.
That's a win for one person, isn't it?
Oh, yeah. And it's not for the person paying alimony.
It's amazing, too.
Because it's like child support, right?
Yeah,
so it's the same thing. It falls into the same way as child support. So if I'm paying child support, that's after-tax money. I've already paid taxes on that money.
Right.
And then the person who receives the child support, then they get that money tax-free.
It's kind of funny, too. You think that the person signing this legislation would actually want alimony to be deductible, right?
You'd think so, right?
I mean, that would make more sense, wouldn't it? Right? Especially if you're paying a lot of it.
Yeah.
But whatever. That's fine. That's a different issue. It's a different show.
But yeah. I mean, I don't know if I don't know if that's the biggest payment that's going out for that for anybody.
That's true. That's true. He likes to make one giant lump sum payment to kind of take care of it in a different fashion.
Now it's a much different show. What we're doing
is that deductible? Is that deductible? Is there anything in here about that?
I don't know. There's some attorneys that are kind of talking about this right now.
Okay, I can build a career around that.
So, so the bottom line is that's so for people who are paying alimony, that deduction is huge, right? So that's a third deduction that's happening, or that's another deduction that is essentially going away or really being repealed. So that's something that is going to could cause some you'd have to make some significant financial adjustments, and then kind of moving forward, right? So everything kind of this is for new divorce decrees. So so anything moving forward, so that's going to probably change kind of the whole landscape of divorce, right? It's going to say, look, now, hey, I can, the judge is going to say, here's how much alimony you have to pay, but they're going to have to take into consideration the taxation of that, right? So they're going to have to say, look, I don't have, if I'm paying, if I have to pay $50,000 in alimony, that's going to cost me $75,000 because I have to pay taxes on that.
Well, you bring up a good point. And I'm not suggesting that much like you would go out and say to yourself, hey, for the tax reasons, I'm going to take a mortgage. No one here is suggesting that for the tax reasons, it makes sense to either get divorced or hurry up your divorce or get the ink dry on that thing, sooner rather than later. That's not what anybody's suggesting. But you have to believe that at some point there was a conversation where somebody might have said, I'm unhappy with the alimony amount, but you know what, I'm going to get a deduction. That discussion, you put the tax people and the financial people and your lawyers in a room, and someone's going to sit down and explain it that way and say, look, I know you're writing this much, but don't worry. You're going to get action. Here's how much you're really writing. It's not that big a deal. Well, now that's not going to be the case. Now the check you're writing is the check you're writing. And to your point, if it's $50,000, I got to earn 75 just to write that check.
That's
Time out. So there's, this is one of those things that as we get closer to the beginning of the year, you'll see a lot of domestic relations attorneys.
On the other end, right? So then look at it from the person who's receiving alimony, right? So we're kind of like in this, poor you got to pay alimony, but there's a reason for that, right? So someone is receiving alimony, and they're like, hey, look, I'm getting alimony because I never worked and blah blah blah, for all those reasons.
Free money.
So now, if those numbers are going to change, if the judge is going to change those numbers based on the affordability of alimony, it could be the person who's receiving it now could be getting less money overall, right?
So it could be substantially less.
Yeah. So instead of like, well, I was going to get kind of $50,000 and then have to pay taxes, or let's say I was going to receive $50,000 and then have to pay taxes on it. Now I'm going to receive $25,000, but I don't have to pay tax on it. But I'm not in a higher tax bracket. You know what I mean? It's not it's not like I would have. Before it would have been more advantageous for me than it would afterward, than would post tax.
Yeah. Well, and it just alters the landscape of those discussions where now potentially it becomes as much a financial decision as it does around sort of a matrimonial, let's kind of wrap this thing up and how do we kind of go our separate ways.
Did you just say a matrimonial thing?
Yeah, you like that?
It sounded awesome. Like as much as like a matrimonial thing about that.
Yeah, it's a matrimonial thing. Yeah, it's good stuff.
All right, so all right, you guys, everybody who pulled over for this one, you get back on the road, start driving because that was important. All right, we're going to take a quick break here on My FM 101.3. Money and the Law, and I'm pointing to the respective Money and the Law. Money and the Law. With Jay Marsden, John Drohan, and Christian from Holliston Cable Access TV. We'll be right back after a short break.
And we're back, Money and the Law, My FM 101.3 here in the New England Bonsai Garden Studios. He's not Jay Marsden.
No,
he's John Drohan from Maine Ever Financial. I'm Jay Marsden from the Marsden Law Group. And we're coming to you live, or kind of live right now, and gearing up for a big 4th of July holiday weekend.
It's coming.
Yeah.
It's going to be here.
Yeah.
It's going to be here. As we were talking about taxes and the new tax code, we're not going to talk about this on 4th of July. And let's just, you know what? I don't want anybody to talk about this.
Well, no, here's what I would ask. Okay, what I would ask of everybody, because the theme of our show, the vibe, if you will, of the show is topics that you really want to talk about, but you don't want to talk about them the way they're usually talked about. You want to talk about them like you're leaning on somebody's, gas grill, not the hot pot, the cool pot, right? And you want to say, look, hey, I got a question for you while you're wolfing down that burger. Here's the situation, and you run a question by John, you run a question by me. And so we wanted to sort of bring that vibe to the television show, to the TV show and the television show, so you get a real sense of it, and hopefully you enjoy the content. But I will ask of you this: 4th of July weekend, when you're standing around talking about it, I'm not saying that you have to get into the deep dive on this material, but at least say to somebody, we're not going to get into the tax code right now, but I did hear
on Money in the
fascinating show, Money in the Law, My FM 101.3 WMRC, talking about the tax code, you should either go check it out or you should at least listen every Saturday.
It just dawned on me. People right now are listening to this show on their way to Cape Cod.
Or they're already there.
Or they're already there.
And if they're already there, there's a relatively good chance they may have had a late night.
Or they're sitting in traffic.
Yes. If you're on your way to the bridge,
right,
God bless you.
Yeah.
God bless you.
If you're sitting in traffic, let's say you're getting on exit 18 in Bellingham, and you are now in like bumper-to-bumper traffic all the way to the bridge.
And I'll let you know right now, just so you know, I hate to break it to you, it's not traffic for the outlets. Okay? All right? It's not for the outlets.
No,
and
it's not traffic for the Bourne Bridge.
And it's not for Plainridge. It's not for Plainridge, okay? Although it seems like it. It's not for Plainridge.
That's what you're hoping. That's like, please let it be traffic for Market Basket on exit 17. That's not happening.
That's right. And hopefully you don't look down and realize, oh my God, I forgot my phone charger, right? Because now you're cooked, right? Now you're cooked, right? And all the texts that are going to go to your phone saying, where are you? Where are you? Are you over the bridge yet? You over the bridge yet? Yeah. You're not going to get those because your phone ran out of gas right around Route 24.
So really, what do you have? All you have left right now is you got 101.3.
Yes.
Yep, 101.3.
And really, what else do you need?
Not much.
That's it.
Not much.
That's
so you know what? We're here with you. You know what?
We're gonna get through this together.
The two of us are sitting in the back seat of your car right now, just chirping in your ear about anything you want to talk about, so long as it's like tax code or money or law or actually anything else. So here we are. We're with you. Let's go to Cape Cod
for the next 6 hours, and we're going to talk. We're going to talk tax code I'll tell you what. We're going to talk tax code until we get to the Rotary. Then you're on your own.
Yeah, then we're changing the subject.
Just so we get over the bridge.
Then we're talking
just so we get over the bridge. That's it.
It's too bad that our show isn't 2.5 hours long because that's how much you're going to be in. That's how long you're going to be sitting in traffic.
Take at least. Yeah. So we used to. So my parents used to come down the Cape, and we were north of the city, right? So you didn't go to the Cape. If you're north of the city, you were New Hampshire people. Yeah. South of the city, you were Cape people, right? Because you didn't want nobody went through the expressway and all that stuff. So my parents would always talk about the Cape, and then inevitably the conversation would go to the Cape and traffic, right? Traffic. So a couple of years ago when we were down the Cape, I said to my parents, why don't you come down and pay us a visit? And they were like, yeah, great. Well, So now they're going to come down at the beginning of the season. So it starts off as, you guys are coming down on Friday. So what we're going to do is now 2 retired people. We're going to get down on Thursday. So we'll get a place. We'll stay over at the place down there so that the next morning when you guys get there, we won't have to deal with
told me the story
traffic, right?
Just so I don't have to sit in traffic.
Yeah.
All because of, and we're not talking like traffic like LA traffic. We're talking about like
Boston traffic. It's a headache.
I mean, it's a headache, but have you ever sat, rarely have you ever sat in traffic for more than an hour.
Yeah, I mean, it happens. It happens. What I always found fascinating was the concept of, God, I love them to death, right? They 2 retired guys, right? My father and my mother retired. And they'd be like, oh, my God, what are we going to do about this traffic? And I think to myself, well, let's see. You can travel, whenever you want. At any given time.
Yep.
My father, who's up at 5 a.m., right? He's up before the birds, for crying out loud. I said, why don't you cruise down? Why don't you cruise down early in the morning?
Pack the night before, right?
You got plenty of time.
So if you start at 5 o'clock in the morning and you hit even a smidgen of traffic, it's going to be for maybe 30 seconds.
Yeah, it's going to be at the Dunkin' Donuts in Medford because you're trying to get an iced coffee so you can drive down and get something to drink on the way down.
I haven't brewed the coffee yet.
Yeah, I can't believe I'm in line. There's traffic. Well, you're on the road, Dad. You're in line at the drive-thru. That's what the traffic. It's drive-thru traffic.
It's true. You know what? You're not alone though.
Right?
So my old man was the exact same way. There is nothing that got under his skin more than traffic. And our lives were dictated by traffic.
Sure, why not?
Everywhere we went, traffic was taken into consideration.
Yes.
Like there was the traffic, like what about the traffic? Whenever we went because we grew up in Connecticut and we went to New York, Cape Cod, forget it. We would go to Cape Cod. So for me, where I grew up, Cape Cod was a 4-hour drive.
Ooh.
Now granted, I think we may have mentioned this on the show before. New York people, if you're driving for more than 60 minutes,
you're losing your mind.
You're looking for a place to stop, right?
Yeah.
So the 4-hour drive, we would get up and we would be on the road at 4:30 in the morning.
Of course you would.
4:30, 4 kids in the station wagon, with like the big like McDonald's, like Big Mac thing on the top, the stuffed suitcase. we'd be in Cape, and all to miss traffic. So of course we didn't get any. There was no traffic, right?
No,
so,
of course not. We're
so
sleeping.
by the time we would get there probably an hour before like the rental place was open.
Oh, yeah.
So we'd be standing there outside, kind of, running around the car, and my old man would be like waiting for the guy to show up so you get the key to the house that we rented.
Yeah, and it's not like today. You don't get there and like, oh, I'll spend an hour checking my emails, checking my voicemails, watching a video on my phone, reading the New York Times, reading see what's going on in the World Cup. I'm going to watch 4 matches. No, you get there and Dad's standing there doing exactly what you just said, looking at his watch, aggravated that the place isn't open because the sun's not even up yet, and then having to tell your mother, entertain these 4.
That's right.
Keep them out of my hair. Here's a Mad Lib. Here, go do a Mad Lib.
Right.
We're out of Mad Libs, Dad. Yeah, that's right.
Read Mom's Red Book.
That's right. Here's a McCall's. Help yourself, kids. Have fun. Enjoy. No seatbelts. Run around in the back. Play a game. Play a game. So, what else you got for tax code here? Anything exciting?
I have one more thing.
All right.
Okay, so I have one more thing, which I saved this for you because this probably applies to you the most. All right, so here we go. Are you familiar with estates?
Somewhat.
All right.
Trust in estates or just estates?
Are you familiar with estates and trust? Are you familiar with the estate tax?
I am.
Oh, yes, you
I am.
are.
Yep. We love talking about it.
So here we are. Guess what? Great news for you.
Oh.
Great news. The estate tax, the federal estate tax exemption has doubled.
Gosh.
Doubled. Thank God.
Doubled.
Right? Thank God. So before in 2017, before the exemption for married couple, Jay married, was $11,200,000. So that's both of you together combined. You were able to combine your exemption for an $11 million.
Yeah, you had a 5.6.
$200,000.
Gave you 2, married you up. Yep.
So your estate, which was probably north of that, right? At least some.
It was becoming worrisome.
Yeah.
Yep.
So 11 million. So meaning that anything above and beyond anything you're above that exemption, you were paying a 40% tax on.
Yeah, we were worried about it. It was
That's
painful.
real.
Yeah.
That's real money. Here you go. The new 2018 tax code.
Christmas come early.
Christmas came early, and the estate tax for you now is the exemption is $22,400,000.
So I get like
22.
Like
you got at least $3 or $4 million to play with there.
That's fantastic.
And
now, by the way, I'll tell you a funny story. When I was in law school and I was deciding to be a trust and estates attorney, I went to my trust and estates professor, and I said to him, I have a question for you. There's all this talk about the repeal of the estate tax and the estate tax going away and the threshold going up and the threshold going down and all this crazy stuff going on. I said, in some respects, I feel like a buggy repairman, getting into the business, as the first Model A's roll off the assembly line. Am I missing the boat here? And he said, he goes, look, the tax piece of it is important, right, for all the obvious reasons of what you just laid out about if you go through the threshold, it's expensive. He said, but because the thresholds are going so high, the issue that really starts to happen around these taxes is it's all about estate administration, right? Which we talk about on the show ad nauseum, right? So to your point, for the folks who feel like, well, if you feel like you're going to be subject to this, call my office right away. All right, like pull over to the car, pull over to the side of the road right now. Get off the highway. Call me right now.
Tell your driver to pull over to the side of the road right now.
That's right. That's right. Lower the screen and tell the driver to pull over right now. But if you're not subject to these things, and even if you are of means, it's an asset administration issue. There's still a need for trust work and estate work in the sense that it's not the tax issue anymore. These are issues around how do we get your stuff from here to here. Right. The mass estate tax hasn't gone away. These are federal issues. But in many cases, many people will say, look, I don't care about the estate tax in Massachusetts. It's not that big a deal. It's not my problem. I just want my stuff to go from point A to point B. That's what I want to have happen.
Well, right, and that's and far more. Like you said, right. If I'm paying estate tax for something, I have assets north of $22 million. Then okay, then I have other issues as well,
that's
right?
right.
So
That's
right. I know this already, right? This didn't just happen to me,
yeah,
right?
That's right. That's right.
So now, however, in the case of mostly everybody else, particularly the people that that I deal with, no one's going to come close to that.
That's right.
No one has those kind of assets. No one has that. But you're right. The administration of your estate is it's huge because this is what you've worked for your whole and there are going to be costs. There's going to be cost if your estate goes through probate. There's going to be probate costs. If there's some sort of like if there's no step up in a basis that you're not for some kind of property, there could be like a transition cost.
Well, that was one of the things I wanted to remind everybody is that the step up in basis does stay in place, right?
Oh, yeah.
So this idea that there was some talk about that at one point going away and carryover basis and all this other stuff. But that's not the case. So you get a step up in basis. So whatever you inherit, whatever you get as part of your inheritance, your basis is for tax purposes is calculated as of what was it worth the day you got it.
That's right.
Those shares of stock that mom and dad bought for a nickel a share that are now worth $300 a share, $400 a share, all that gain when you inherit those securities goes away and you get a fresh start going forward from a tax perspective.
Right, which is the same thing with respect to property as well. So that basis, that step up in basis is huge. So for instance, like that, the Cape house that's been in the family.
Yeah, the one you're driving to right now, stuck in traffic, that mom and dad paid $22,500 for way back in the day.
Right, they took out 3 mortgages to pay $22,000, right, or $40,000 to buy this house, and now that house is worth $1.3 million.
Yes.
Guess what? When you inherit, you and your brothers and sisters inherit that, you're not inheriting the $22,000 house that, oh, by the way, we have to pay capital gains tax on. You're inheriting the house as it is, $1.3 million, and that's where you start.
Sell it a week later, no taxes. Hang on to it, your tax basis starts at 1.3. You sell it for 1.5.
There you go.
You pay taxes on the 2.
Right.
Not a bad deal.
Yeah, not the worst thing that's happened anyway.
I'll take it. All day long, yeah. I'll take it.
All right.
Speaking of taking it, we got to take off.
We got to take, yeah.
We got to take off.
I'm sorry we can't stay with you on your ride any longer.
If you can see the bridge, congratulations. Yeah. Great job. Well played.
But you can stay here on my FM 101.3 for as long as it'll go.
Absolutely.
And it's a powerful radius. It's shooting. Yeah, it's out there. So you may even get it. I have caught a glimpse of it being out on the outer Cape.
On the boat.
Yep.
Yeah, on the boat. On the boat. Yep, on the boat. On the island. Keep the island.
All right. So, Christian, have a great 4th of July week. Jay, have a, I don't know.
He seems so relieved with the alimony thing.
I don't even.
I love
it. Like, oh, that's good. Jay, you have a great 4th of July
I'll do my best. You do the same, my friend. Enjoy. No fireworks. Remember, no fireworks. Stay away.
Yeah, they're dangerous. Yeah, be careful. Yeah, leave that to the professionals.
Yeah, let the pros do that.
All right. We'll see you next time on Money in the Law.
Have a great weekend, everybody. Happy 4th.